What if the explosive stock market rally you are witnessing right now isn't the beginning of a permanent tech-driven golden age, but the final, most dangerous blow-off top of a historic financial bubble? Right now, millions of retail investors are logging into their brokerage apps, watching a handful of artificial intelligence and semiconductor stocks hit astronomical all-time highs week after week. The mainstream financial media is flooded with narratives explaining why this time is different. Analysts are claiming that the emergence of generative AI and automated systems has completely rewritten the traditional laws of valuation, making corporate debt and interest rates irrelevant. Desperate not to miss the train, everyday citizens are cutting back on their basic necessities, liquidating their stable assets, and even taking on personal credit debt just to pump capital into hyper-growth technology stocks at the absolute peak of the market. But history has already written the ending to this exact script. Imagine waking up to a market environment where the liquidity driving your favorite tech stocks suddenly evaporates overnight. Imagine a scenario where a minor corporate earnings miss from a leading semiconductor giant triggers a cascading margin call across Wall Street, causing over $1 trillion of paper wealth to vanish in a single trading session. For the unhedged retail investor, the resulting crash wouldn't just be a temporary correction, it would be a terminal financial blow that wipes out decades of hard-earned family savings. This isn't an alarmist conspiracy theory. This is the precise mechanical warning issued by billionaire macro investor Ray Dalio, the founder of Bridgewater Associates. Throughout his 50-year career managing capital for central banks and sovereign wealth funds, Dalio became a master of what he calls the bubble gauge. By studying the historical data behind the 1929 market crash, the 2000 dot-com bust, and the 2008 subprime meltdown, Dalio mapped out a mathematical checklist that accurately identifies when an asset class has moved from legitimate growth into speculative madness. According to Bridgewater's quantitative metrics, the current tech sector has officially begun flashing red on the most dangerous structural markers of a classic market bubble. In this video, we are going to use the Dalio Blueprint to conduct a brutal reality check on your portfolio. We will decode the exact mechanical indicators proving why this tech boom is sitting on a fragile foundation of leverage, how the corporate elite are secretly preparing for a liquidity freeze, and step by step, the exact risk parity strategy you must deploy right now to protect your capital before the tech bubble inevitably pops. Let's look inside the economic machine. To understand why Ray Dalio is raising the alarm, we must look at how a market bubble actually operates. A bubble never starts out as a scam. It always begins with a real, world-changing paradigm shift. In the late 1990s, the internet was a genuinely revolutionary technology that altered human capability forever. Today, artificial intelligence is an undeniably powerful engine of productivity that will restructure entire industries. But Ray Dalio's research proves that human psychology always distorts technological progress into financial mania. The cycle always follows the exact same path. Phase 1, a breakthrough technology emerges, and the early investors make massive, legitimate returns. Phase 2, the mainstream media catches wind of these returns and broadcasts them to the public. Phase 3, a wave of emotional greed, known as the fear of missing out, or FOMO, infects the retail population. Regular people look at the skyrocketing stock charts and assume that the price increases will continue vertically forever. They stop buying a stock because of its underlying corporate earnings. They buy it simply because they expect someone else to pay a higher price for it tomorrow. This is the exact structural trap that the tech sector operates in today. Look at the quantitative metrics. Ray Dalio's classic bubble gauge tracks 6 specific economic indicators to determine if an asset market is in a bubble. Indicator number 1, are prices high relative to traditional measures of value? Today, the price-to-sales and price-to-earnings ratios of leading AI and tech companies have detached from reality, trading at multiples that assume corporate growth will remain infinite for the next 30 years. Indicator number 2, are prices discounting unsustainable conditions? The current valuations assume that these tech giants will maintain a total monopoly on artificial intelligence infrastructure forever, completely ignoring the fact that competitive capital is flooding the sector, which will inevitably compress corporate profit margins. Indicator number 3, have many new buyers entered the market? Over the past 24 months, millions of first-time retail accounts have flooded into the stock market, heavily concentrated in just 5 to 7 massive technology tickers. Indicator number 4 is their exceptionally bullish sentiment. Wall Street analysts are currently presenting the highest percentage of buy recommendations in modern history, creating a dangerous climate of universal optimism where nobody is pricing in downside risk. But it is indicator number 5 and 6 that represent the ultimate tipping point for Ray Dalio. Are purchases being financed by high leverage, and have buyers made extended forward purchases? To sustain a vertical price chart, a market requires a continuous, expanding inflow of new cash. When regular investors run out of their own savings, they begin to borrow capital to buy more shares. Today, margin debt, the amount of money retail and institutional traders are borrowing against their portfolios to double down on tech stocks, is climbing at a historical velocity. At the exact same time, major tech corporations are taking on massive corporate debt to execute historic stock buybacks, artificially pumping their own share prices to satisfy institutional shareholders. Ray Dalio warns that this creates a highly top-heavy, fragile financial architecture. When a market is fueled by massive leverage, it becomes hypersensitive to the price of credit. Central banks around the world have been forced to maintain higher interest rates to combat persistent structural inflation. When interest rates stay elevated, the cost of carrying that massive mountain of margin debt becomes incredibly expensive. The economic machine is running on a critical mismatch. Stock prices are priced for absolute perfection, but the macroeconomic environment is sitting on a tight liquidity squeeze. So, what happens when the tipping point is reached? Throughout history, bubbles never slowly deflate. They rupture violently. The trigger is usually an unexpected, minor catalyst, a leading tech company reporting a slight slowdown in data center demand, a sudden regulatory crackdown on AI privacy laws, or a geopolitical escalation that disrupts the semiconductor supply chain in Asia. Because the market is highly concentrated and fueled by borrowed money, the first wave of selling triggers automated stop-loss orders from institutional algorithms. As the price drops, brokers issue mandatory margin calls to retail traders, forcing them to liquidate their positions immediately to pay back their debts. This creates an unstoppable domino effect of forced selling. The very same leverage that pushed tech stocks to the moon on the way up acts as an absolute accelerant on the way down, turning a standard market correction into an unmitigated panic. The retail crowd that bought at the absolute top gets completely wiped out, trapped inside an illiquid market door with no buyers on the other side. When a paradigm shift of this magnitude occurs, Ray Dalio urges investors to stop acting like emotional gamblers and start acting like systematic engineers. If you assume that holding a concentrated tech portfolio or leaving your money in a generic S&P 500 index fund is a safe strategy for retirement, you are misreading the macro machine. So, how do you apply the Dalio Blueprint to insulate your hard-earned savings from a catastrophic tech bubble pop? The Bridgewater playbook provides 3 concrete strategic steps to re-architect your portfolio today. Step number 1, you must aggressively enforce the law of risk parity. Most retail investors believe they are diversified because they own a mutual fund that holds a mix of technology, consumer goods, and financial stocks. But as we established, during a severe liquidity crisis, all equities become highly correlated and drop together. True diversification means balancing your risk across entirely independent asset pillars that thrive in different economic seasons. The baseline all-weather strategy requires you to reallocate your capital into a highly resilient matrix. 30% in globally diversified equities to capture long-term human productivity, 40% in long-term government bonds to protect your capital during a corporate growth recession, 15% in intermediate bonds, and crucially, 15% in hard, unprintable assets. Step number 2. Accumulate your hard asset inflation shield. When a speculative equity bubble bursts, institutional capital doesn't disappear. It searches for a safe haven that carries zero counterparty risk and cannot be devalued by a central bank printing press. That safe haven is physical gold and tangible commodities. By allocating 7.5% of your portfolio to gold and 7.5% to a diversified commodity index, you create a powerful macroeconomic shock absorber. When faith in paper equity market shatters, money historically floods into hard assets, causing their purchasing power to surge vertically and offsetting the losses in your equity module. Step number 3. Implement strict, emotionless rebalancing. This is the ultimate discipline of the world's elite corporate investors. When tech stocks are booming and generating massive nominal returns, Human emotion tells you to sell your gold and bonds to buy more tech. But the Dalio Blueprint forces you to do the exact opposite. Once a quarter or once a year, you look at your target allocations. If the tech boom has pushed your equity module from 30% up to 45% of your total wealth, you must systematically sell that extra 15% at the absolute peak and use that cash to buy the underperformed, discounted hard assets and bonds. You are mathematically forced to lock in your profits at the top and buy safety at a discount, completely ignoring the mainstream media narrative. The economic machine is moving forward exactly as it has for centuries. The technology behind the current boom is real, but the financial mania built on top of it is a mathematical illusion that cannot withstand the late stages of a long-term debt cycle. The middle class gets caught unprepared because they confuse market hype with structural safety, chasing vertical charts until it is too late. But those who eliminate their cognitive biases, understand Ray Dalio's bubble metrics, and position their capital into an independent, all-weather vehicle will protect their families, preserve their purchasing power, and be ready to acquire world-changing assets at a deep discount when the system inevitably resets.